Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And today I got a very special guest. I'm speaking with David Skarica, who runs the website addictedtoprofits.net. How you doing today, Dave?
I'm pretty good. Actually, I'm doing really good. It's beautiful here today. I'm inside, but when you see my hair blowing around, it's because the last few days it's been abnormally kind of cool for this time of year in the Bahamas, with like a really nice breeze. Because usually by May you're putting on your air conditioning all day, but it's been so nice here. I just been hanging around, kind of like I'm not in my office. I'm in my I'm in my living room on my laptop, kind of near the windows and doors, and also just been sitting out on the deck and that sort of thing.
Well, your website, addictedtoprofits.net, it's like a blog. You talk about the financial markets. You've been trading, investing since the 1990s. You saw the internet bust. You saw the 2008 crash. You've seen commodities and gold and silver have its boom and bust cycles. And now this year, the stock market has been dropping. It appears to be a bear market, but at the same time, a lot of traders out there, they're looking to make money. They're looking to try to find the bottom and try to buy. There's millions of people that have Robinhood apps and people that want to get involved in these markets. Today we're down. If someone's new, they just opened up a Robinhood account this weekend. What would you tell them? Do you think this is a good time they should be diving in and buying stocks?
Well, the problem we have now is I don't think people realize what a crazy bubble we were in, and just how overvalued we were, in the markets. Like for example, I've talked this. I don't know if you want to put the chart of this up. You just do a Google search. But if you look at market cap to GDP, of the markets and stuff, is like that's Buffett's favorite indicator, and it's like the total size of the economy divided by or the total size of the market cap of the stock market divided by the size of the economy. And historically, actually, the mean or the average is about 70%. So let's just say roughly the stock market's 2/3 or 3/4 the size of the economy. And during some major bubble highs, like the late 20s, or 2000 or 2007, it gets to about 100% of GDP. Actually, in 2000, it got to 150%, and you can see it got to 200%. What's crazy is we are still where we are at the 2000 high right now, or we're at the 2000 high right now. Despite this big drop in the markets. So that is just how overvalued. And then there's another one called price to sales, which Ken Fisher really used to like to look at a lot. And price to sales, and this is a Schiller PD. This is another one. I'm putting out a video right about the same time I'm going to be putting out, actually right after we do this video. This will probably come out on Wednesday on my site. On Tuesday, I'm going to put out a video on long-term valuation. I talk about all these things. And basically, Ken Fisher, the price to sales is I think it's still like 2.3 to 1 right now. And then basically actually that same website you're on has price to sales right now. You'll see it at the top. Or maybe you have to scroll down.
Well,
but I know that website has that same website, because I know that's the same website I used for my video. And I think it's 2.3 to 1. It got up to 3. Well, 2.3 to 1 was about the .com, again, high in the markets.
Here we go.
Yeah. So we're at these, you can see it's 2.5 to 1. It's even higher than I thought. And I think it was like 2.2 or 2.3 to 1. This only goes back to 2001, but in 2000 at the top, that's where it was. So what we're seeing is we had this massive overvaluation. You can see what was interesting, because in 2009, PDE didn't really matter on the S&P because they had negative earnings because the banks were losing so much money, right? And the banks were a large part of the S&P. But this went under one-time sales for the first time in like over a decade. And market cap to GDP, I think, went to about that 60-70% level again for the first time in over a decade in 2009. So these were good to show that the market was a good buy back then. And these, again, right now are back to the 2000 valuations. So why did we get to these ultra crazy valuations? I think there's two reasons. Quite frankly, zero interest rates means that you're going to pay up more for equities, right? Because you have zero interest rates, it means if the S&P is yielding 1.5%, it was like, 1.5%, 2%. And so you'll up to those valuations because you're getting like 0% or 0.5% on your 10-year bond. And then secondly is that they, that QE they did from 2020 to 2021 was even bigger than the ones they did, after 2009 or in 2013, 14. So you had QE with these zero rates, and that just kind of juiced anything. And then you had this thing where like these companies that are all like these kind of ARC plays, I guess you could call them, or the stay-at-home plays, were like, Zoom and Amazon or whatever. It's like these all benefited from people having to stay at home because of the pandemic, and then people were trading more because they were sitting at home collecting unemployment, not working, with nothing to do. And you can see Amazon right there too, right? And what's interesting is these stocks, Amazon is basically back to its pre-pandemic high. They've given back all their gains, which shows like it's kind of like maxing out your credit card. Yeah, it's fun for a little while, right? Like you can maybe buy a car and have a nice vacation and buy a boat or do whatever the hell you want, depending on your maximum limit on your credit card. But when the bill comes due, your life is going to be crap. The problem with all of these companies, they kind of front end loaded all these sales because people couldn't leave their houses. So people weren't going to real meetings or going to Zoom meetings. People couldn't go to Macy's or Target or Walmart or whatever, and they were going to, just buying off Amazon. Like Amazon in that last quarter, where you can see it kind of gap down there, they reported only 7% increase in revenues. And if you take into account that inflation is now over 8%, that's a decrease in revenues, inflation adjusted, and there's bottlenecks now and things are taking forever because of supply chains. I know, like living on an island here, we don't exactly, again, have Walmarts or these big stores. So Amazon is, I use that and eBay and all these stuff. And I've almost stopped using them because the whole point of Amazon was, okay, I could get to this forwarding address I have in Florida in a few days, then here a week later. And then but it's like, well, now it might take a week or two to get to the address in Florida than here. And it's just like, what's the point? It's just like, it's not this good expedited service with cheap prices anymore. So like Amazon, in my opinion, is now going to become like a Walmart. It's going to be like an online version of Walmart. The margins aren't going to be good. The growth's not going to be there. Their costs aren't as low as they used to be, which means that whenever it settles in, and who knows where the low is, 1,500, 1,000, ultimately, it's going to have to be more of a value play and then start, redistributing in dividends, kind of like Walmart does.
Well, let me try to give an argument against what you're saying and the best I can. You're talking about valuations. You just talked about earnings. You mentioned Warren Buffett, Ken Fisher. These are really old men. I think Buffett's like 90, Ken Fisher's in his 70s. These are old concepts that they got. They talk decades of this stuff. What about this? Last year, AMC, GameStop, they went up a lot. And all these people had Robinhood accounts and they were posting on Wall Street Bets. And I saw Rachel Maddow talk about it, and Tucker Carlson talk about it, that this was really a revolution, and all these other things you talked about, really, that's old stuff. And if we can just get people to buy and more people to open up Robinhood accounts that don't believe any of this stuff you're talking about, and if they can have diamond hands and just agree never to sell and just buy, if we can get the people to make a new commitment to do that and get all agree to get 3 other people to join in and agree to all this and buy too, couldn't we reverse the situation and get the markets back up where they were in January?
No, and I'll tell you why. And it's not just the sentiment and not ignoring valuations. Like, first of all, one of my largest put positions, I got a straddle on it now because it is now pretty oversold, but they're having earnings actually tomorrow, is NVIDIA. And one reason I just got bearish in NVIDIA at the beginning of the year, and I'm not trying to like bang my own chest, but I probably got bearish in NVIDIA north of 300 mid-December or so. And, I was pretty close to the high. And I did buy a few puts last year, but they were like way out in time line when I bought them last July, because I didn't think NVIDIA was close to topping yet, but I wanted a hedge, etc. And it was just quite simply, NVIDIA was trading at 30 times revenues. We're talking about that price to revenues. And I don't care what kind of growth you have. You really have to be growing at 300, 400, 500% a year, in my opinion, to have to really justify 30 times revenues. And if you go look back at Cisco and Amazon and all these stocks back in 2000, none of them were trading at 30 times revenues. That was of the established companies. Maybe the .com that had no revenues, was trading at some crazy valuation. And NVIDIA at its height was trading a $700 billion valuation. Just think about that. Like, again, 10, 20 years ago, that's the biggest company in the world, and now NVIDIA is, it's just like this growth chip company. So I don't think so, for two reasons. Like I said, it's like the valuations, those excessive valuations and cheap money is over, right? And then secondly, like you're talking about, why it can't go back up is, look, with stagflation and higher inflation and supply chain issues and whatever, it's killing these companies. Look at Walmart again, look at Target, look at Amazon. You're talking, you may say, oh, Walmart and Target, they're old companies. Like, Amazon is one of the growth companies. That's it laughs at me about the crowd that says, oh, the Fed is going to like chicken out at some point and not raise rates and the markets will go back up. Well, guess what? Rates are basically, under 1%, basically zero. And that didn't stop Target, Walmart, and Amazon from blowing up. So because what happens with stagflation is your costs go up, your revenues stay stagnant, and your margins go down. So having diamond hands is not going to change that shift where these companies are having all of these problems. And look, if you believe in the quote unquote, don't fight the Fed, well, it's like, what caused this in 2020 and 2021 was the Fed dropping rates to zero and printing trillions of dollars. Well, not only, and this is something nobody's talking about, is the Fed going to raise rates a couple more times and probably at least raise the Fed funds rate to 2%. They're doing quantitative tightening starting June the 1st, basically a week from now, which means that instead of like printing, whatever, 100 billion a month, they're going to be taking away 50 billion a month. So no one talks about that, but that money printing is just as important to these big financial bubbles as anything,
Well, so what do you think, people? What do you think then?
The diamond hands doesn't work in that environment. That's what I'm saying.
Well, if you can't just buy something and have it go up the next day and make money, or get on the Robinhood app and buy the top stocks and make money, how do you make money in this market?
Well, like I've been shorting a lot, but that's tough for the average person to do. I understand. Like, I'm not an extremist. I don't think you need to just be like all short, all cash, whatever, right? But like, there's an ETF I like called the hedge, HDGE, H as in Hamilton. I'm from Hamilton. Why not? D as in Dundas. It's another town I'm from. G as in Gregorytown. And E is in Eleuthera. So all places I live or have lived, right? So anyhow, you could just hedge your portfolio with like putting 10% in something like that. But I think now it's more about protection. And by the way, you don't have to be a hero. You don't have to be someone that like, oh, the market crashed. I made 10 times on my money, like whatever, like the big short guys. Like when David Einhorn kind of got famous for shorting Lehman Brothers, his fund that year, I think, lost 17% in 2008. But that was great because the markets lost like 40% that year, right? And if you go look at the history of Templeton and Buffett and these guys in these bear markets, and these guys don't short, they would just go heavy cash when they figured the markets were overvalued. I think one reason that Templeton really outperformed in the 70s was, like, for example, in the 73, 74 drawdown, which saw the S&P and the Dow drop 45%, I think Templeton only lost like 15%. So like just be more conservative, defensive plays, higher levels of cash, maybe put 10, 20%. I'm not a financial advisor, so it's not financial advice, but in kind of these ETFs. And I'm not talking about the 3X things. I'm talking like, you know, that said the hedge or the RWM, which is the Russell 2000 inverse one, you know, or the ones that are just 1X, you know. So if the market goes down 20%, you make 20%, right? And the idea is, let's say you're 10% hedged, and that can, I don't know, double, you know, the market goes down 50, you know, 40% or something. Well, you make 10%, maybe the 80% you're vested in loses 40%, so that's a loss of 30%. Boom, you only lose 20% when everyone else has lost 40. And that's a really good thing in a bear market. And then you can close out your hedges and start buying equities and companies when they're cheap. Like another video I just did, if you go on my website right now, and you publish this too, you blasted it out, was a video on maximum pessimism investing and buying beaten up assets. And again, as sexy as it is to chase the Amazon, and like you said, have diamond hands and chase the Zooms, the real time to buy is you wait for these stocks and sectors and markets to drop 80 to 90%. And then the 2-3 year returns are usually always north of 100 or 200%. You know, the perfect example is I remember in the mid 2010s, I started getting bullish on the 3D printers because they blew off in 2014, and by 2016 they were all down like 90%. 2016, 2017. No, it took like 3 years, but then most of those went up 3 to 10x from like 2019 to 2021. So but even if you're sitting there making no money for 2 years, when you get a 5 or 10x return, annualized over 3 years, that's pretty good. So that's what I recommend people to do. Like, start looking for beaten up sectors. And some sectors are getting there right now. I actually think, and it's been a terrible sector. And I'm from Canada where the bubble was, but at some point these marijuana stocks will become good buys. I think it's still a little too early, but again, most of them are down between 95 and 99%. So they're kind of like the dot-coms in 01, 02. I don't think they're going to go back to those highs, but they'll have a very good rally at some point. And another example is of a stock that did that is in 2009, Crocs, back pre-financial crisis, was really hot stock, who make those plastic shoes. And it went from 70 to $1. And then from 09 to 011, it went from 1 to 30, right? So it went up 30x, right? From 09 to, and then actually I think it went back to a few dollars again, and then it had another blow off to like $150. So like that was just an individual stock, went down 99%. I'm not a big fan of those Crocs shoes, but that's a company that's going to stay in business, is not going to go under. And then in two cases, actually, I'm looking at 2017, it went to, I think, about $4 or $5. In two cases, it went into the low single digits and then went up like 30, 40x, So, Crocs right now is 49, by the way, the high is 180. So it probably has a ways to go down. But again, like, I don't know if that stock going back again to single digits again, it's probably worth a buy for, for a good trade. So really it's, you have to be really disciplined to trade like that. You may not even make a trade for months or years, but your returns are going to be just as good, and you're not chasing, and then you're not as vulnerable to like buying something that was really overvalued, like, for example, let's look at Netflix, for example. That was a hot stock. Everyone loved it. Netflix is back to where it was in 2017 now, when it's, trading here at about 180 a share. Well, that means anyone, even though at one point, anyone who bought it in like 2018, 2019 had doubled, tripled their money, now they're all underwater. And that's the problem with chasing something when it's, when it's expensive,
But people want to do something right now.
I just think right now is really difficult because, like I said, I do have shorts. I have been shorting, but it's like, I don't know if I'd be telling people to short here because the VIX is high. The markets have, the NASDAQ is down over 20% from its highs. I still ultimately think it's going lower. I still think these next two Fed rate hikes are going to still drive the markets lower. but it's just tough to, for me to short. Like I said, when, you know, I'm basically too with my put options, I'm rolling the money over and just using the initial capital and basically keeping the profits. So it's like I'm playing with the house's money,
Well, there's Fidelity's got this thing I like to look at showing the number of stocks and the buy and orders.
Yeah.
So like Tesla today is
No, we
down
watch this every day and it's
Yeah,
hilarious.
yeah.
In my opinion.
Tesla's down 5%, 6,700 buy orders, 3,600 sell. Facebook's down 9%, 4,700 buy orders, 1,500 sellers. You know, it's a down day in the markets, and these people on here are piling in. You know, they're not selling. They don't care about these Buffett indicators or earnings not being great. In fact, when they see bad news, like Facebook had bad news yesterday, that came out that the district attorney for Washington, D.C. Is saying that Mark Zuckerberg knew all about the Cambridge Analytica scandal while it was going on and didn't care, and he wants to go after him. And the stock's down on that news, but people don't care that that's bad news. They want to buy. So when you think that people should kind of wait for a little while, that these people don't want to wait. You know, they see the down days. They want to buy. They're going to keep buying till they can't, I guess.
Well, like one of the most, you're talking about that, it's actually not on there today. And like, for example, you're talking, another stock that's on there, Snapchat, which is down 41% today. And there's almost 3 times as many buys as sells. And it's, like I said, it's not on there today, maybe because so many other stocks are down more, like.
Well, look at AMC. It's down 8%, 3,000 buy orders, 450 sellers.
Look at GameStop. It's on there almost every day. It's down 7% today. Almost 3,000 buy orders, 2,800, 300 sell orders. And I'm telling you, that stock is like that every day on there. And Google, all it's been doing has been going down basically since the beginning of the year.
What I'm trying to say, Dave, is you're saying these ideas of Warren Buffett or Ken Fisher make sense to you, but what you're advocating goes absolutely against what Robinhood people are doing, what people in Fidelity are doing, what people want to hear. You're going completely against what people want to do. How can you do that with a straight face?
Here's another thing that, we've talked about this. We're just laughing at these people. I think these people don't know what the hell they're doing too. I don't know. They're smoking crack during the day while they're trading. I don't know what, no offense or anything, but I don't know. They know what they're doing. But
here's
another problem too.
Go ahead.
Is I think, I just mentioned Amazon, but all of these, like, for example, these retailers, their whole model for like 20 to 30 years since China really, blew up and it, became this big, place where everything was made, industrial, power, was their whole thing was, these companies was, we're going to make this cheap crap in China, ship it over here, either Amazon sell it on our website or Target and Walmart sell it in our stores, pay people nothing, and then, who work there with no benefits, no nothing. And then, have a big profit margin. Well, now because of inflation, there's wage pressures. And, like a lot of people aren't working unless they get paid a good wage. So there's wage pressures. You have these supply chain things and inflation. So the stuff all costs more. So what I'm trying to say is that model is broken. So you can't just be a Fidelity fool or Robinhood. It's another, I don't want to be politically correct, but another word that starts with an R, and go on there and buy this stuff just because it's fallen today. You got to realize when you're looking at those charts, like, I don't know if you can put up a chart at Target because it's down 5% today, and that's after the huge gap down, and I just put up on my computer a 10-year chart of Target, and that's not maximum pessimism, by the way. Target's low in like 2017 was like $50. Okay. The thing's 150 now. So like that thing still has a long way to fall. But I just think you look at that And it's like, this model is broken. So just sitting there going on Fidelity and doing this and that, these people are all trying to make what has in the past. And we're like at one of these inflection points that doesn't happen every so often. Because one thing about, like, you talk about 1929, for example, and I'm not saying the markets are going down 90%, because I don't think that will happen. I think they'll inflate their way out of this before something like that happened. But when I do look at 1929, everyone talks about the crash, but no one ever talks about from 29 to 30. There was this huge rally that took back like 50% of the losses. And how many people just thought, oh, this was a financial market crash. The economy is going to come back. It's going to be booming like the 20s again. We're buying that rally. And then the market rolled over. And, the summer of 2000 was kind of like that in the tech stocks, or all the rallies, bear market rallies the market had in 07, 08. I remember one thing that happened in 07, 08 was people never thought real estate could go down, because it never had really gone down like it did during that bear market. So we're at one of these inflection points where I just don't think what's worked for the last 30 years and definitely, definitely the last 12 years or 13 years since, the 2009 bottom is not working. We're seeing that,
Well, there are things that have gone up this year. Energy has gone up. Commodities have gone up. Wheat prices have exploded. And even the price of gold, even though it's come down, I'll load up the GLD ETF, even though it's come down from the high, it's still actually up year to date, and even it's up today. So what are your thoughts on people trying to, park money there?
Okay, like recently I actually bought a couple really beaten up. So we do a lot in juniors. So these are two juniors that are near production. One was like a 40, 50 cent stock. It's called African Gold, AGG.V. Another one is Eurosun. Africans, obviously in Africa. Eurosun is in Romania. Another one called Aftermath Silver that me and you like is another one that's like, I think it's about a quarter right now. It used to be $1.50. So I think these kind of things that are beaten up 80, 90%, that have resources, this and that, I'm actually picking away. Now, who knows, maybe gold will fall with one more down tier in the market, but I do find it interesting that what we've seen in the last week or two is that gold has been rallying while the market has been following. And if you go look what happened in the fourth quarter of 2018 or the first quarter of 2009, is that even when you had this leg lower in the market, at some point during the last leg lower, gold actually disconnected and started rallying, anticipating maybe a turnaround or anticipating that at some point rate increases would stop. So I still think they're going to do the next 250 basis points, but maybe gold is now looking out past July and also is kind of being like a fear trade, not a fear trade, but, flight to safety trade now, which we haven't seen. So
one thing that may be helping is bonds, such as an ETFs for bonds like the TLT ETF, aren't going up, even though the stock market's going down. And they, in the past, bonds would rally. Now they go down. So,
well, the thing about bonds is I think they could rally here because they were just so oversold. But the thing about it is, you go look at a longer term chart of whatever rates or the TLT, it really looks like, again, a massive shift of what we from what we've seen. Forget the last 20 years, the last 40 years, where bonds were always going higher. But where's the TLT really going to go on this bounce? 125, 130? I think that we are now going to see a long-term series of lower lows and lower highs on the bond rather than higher highs and higher lows. And I think that's something so if you wanted to trade a bond, you think the bond's going to rally because the market's going to go down, fine, whatever. I just don't think it's going to work like it did in the past. And I think you're right. I think that helps gold even more, because then it becomes like what happened in the 70s, where bonds sell off because of inflation, and really your only safety net becomes, gold and precious metals. And I think one thing that crypto has shown itself right now is crypto just trades with the NASDAQ. It's got like a 90% correlation with the NASDAQ the last year or two. it's not trading as some kind of inflation hedge. So, you know, and we've had that Luna coin blow up, and there was some other coin that was doing something. They called it monkey self something with the monkeypox, and it ended up being a big scam. So it's just like, like, you know, it's just, I think that the precious metals are starting to show themselves that they are basically going to be, kind of the only, you know, game in town in terms of being a hedge, a real
Well,
hedge.
right. Well, we've covered a lot of topics. So as we wrap up, I want to ask you or give you a chance the people need to know what more information can you provide people? How can they get involved more with what you're doing?
Yeah, so like I said, like right after we get off this, I'm gonna put out this. So if you go on my website, addictedtoprofits.net, I've got a really interesting video on maximum pessimism investing. I mentioned a couple gold stocks I like right now. Actually, a couple other stocks. Like I'm actually looking at stocks in Sri Lanka right now because that's maximum pessimism. Their economy is totally basically collapsing. And some other things, and how this has worked in the past. I'm putting out this one on kind of like long-term valuation, that sort of thing. So then basically these are the kind of videos I'm going to do going forward. And next week, so June the 1st, I'm going to launch my service, which will have a watch list of securities. I do option trading. That's the top end service. And, educational videos. I'm going to do a series on like great investors. So I'm going to, that guy was my mentor for a while, named James Dines, did a lot in technical investing. He passed away a few weeks ago. So I'm going to talk about, he's the first guy I'm going to kind of cover, but I'll talk about Templeton, Soros, all these, Paul Tudor Jones, their investment styles. So the way I'm going to do it is everything with access to maybe, getting into junior mining, private placements, plus option trading, plus more like a daily commentary. That will be, I have a lifetime subscription, which is usually $2,500 a year, going to offer for $1,250. So you'll get 1 year to that with the $1,250 lifetime. And then I have a more basic subscription, which is $70 a month, which is more like 1-2 updates a week, some of these stock recommendations, commentary on markets, etc. And then I'm gonna have a lower end, like I said, that's $70 a month or $840 a year. And then I'm gonna have a lower end service where, maybe I just do a video once a week and it's going to be optional, but, the videos have been blasting. It'll be like a Patreon service. I'll sell it for $6 or $7 a month. And if you can just help keep that going. So, I don't have to have advertising and the whatnot. I prefer to have it subscription based. I'll do that as well. So, and that's for like people that just kind of want to be educated and that sort of thing. So I'm going to try to launch all of those June the 1st. And then, the reason I wanted to launch this late last year, but it's taken me so long because I really wanted to come up with the concept of what I wanted to do, and I think I'm there now. And, I'm putting together these educational videos. And actually this week, I'm going to have a couple good stocks, which I think are kind of special opportunities that can do really well. And these will, again, just give you a kind of sample of kind of the stuff I look at and the way I trade, etc.
Well, great. And thanks for talking to me and everyone else. And we'll do some follow-up interviews sometime soon. And everyone out there, tune in for next time.
Yeah, thanks for having me.